Wells Fargo, as we know, has a slightly different profile, certainly than Goldman Sachs, more retail-oriented, more mortgage-oriented. What do we know?
We know that we're 3 for 3 on net interest margin misses.
Yeah.
So all three banks missing net interest margin, as you pointed out, net interest income coming in below estimates. I think for Wells Fargo, we've already lowered the guidance a couple of times, expecting, I think they said most recently at the lower end of a down 5% type range for the year. We're going to be looking to see how mortgage banking did. We saw their revenue estimates kind of floating up coming into the quarter, likely due to that. Part of the reason why they have lowered their net interest margin and income target is due to lower long-term rates, and they should be getting some offset from mortgage banking.
Interestingly, the total average deposits for the second quarter was down to $1.3 trillion, down from $2.4 trillion. This according to reporters that are digging through this. Also, their average loans were down $2.6 billion from the first quarter. Bill, what do you make of this, given the fact that Wells Fargo has faced a bunch of reputational issues, certainly over the years? Do you think that there are signs that perhaps clients are pulling back as a result?
Well, Wells Fargo is a classic value stock, right? It's there's such low expectations attached to it now. You're in that stage where whatever short-term negatives really don't matter as much. So first off, what they could do with their capital was capped for a year. So you have to take that into account. You have to remember that there's a certain amount of growth in certain categories that couldn't happen because their ability to use their capital to the full extent that they might have wanted to was limited by the Fed. The second thing with Wells Fargo and all these banks is the strong part of their business should get you very excited about the next 10 years, which is the consumer, because there's 89 million people, average age 29, that are going to be 35 in 6 years. And a 35-year-old married customer with a child is a way better consumer customer than a single person that buys Apple devices, eats Chipotle burritos, and drinks craft beer. A person with a household buys and borrows by necessity rather than by whim, and that's where we're headed. So here's the great irony of all this, and I'll include J.P. Morgan in with my comments because you were talking about them before. These businesses are doing extremely well with only a 25 basis point spread between the 2-year and the 10-year. But during the quarter and during the first part of this year, that spread dropped down to only 11 or 12 or 13 basis points. So I think everybody is overanalyzing this situation. If the housing has been, for the last 10 years, the smallest percentage of GDP in the last 40 or 50 years, and as it normalizes the next 5 years, these banks are going to gain a lot of liability action from people that have never taken on liabilities before.